Market traps, false breakouts, failed moves. In our last lesson, we followed the footprints of big money, the quiet signs of accumulation and distribution that reveal the intentions of the market's giants. But as powerful as those insights are, the path to mastery does not end there. Because the market is not only a teacher, it is also a trickster. And to survive, you must learn to recognize its deliberate deceptions. These deceptions take form in false breakouts, failed moves, and head fakes traps designed to lure the impatient, the emotional, and the greedy into positions destined for failure. To ignore them is to walk blindfolded into danger. To recognize them is to turn the market's traps into your opportunities. Before we dive deep into the anatomy of these traps, let me pause for a moment. If you've found value in these teachings, if you want to sharpen your ability to see through the market's illusions and develop the discipline of a true speculator, then make sure to subscribe, like this video, and hit the notification bell. This journey is long, but every lesson builds on the last, and you'll want to stay with us all the way to mastery. The nature of market deception. The market, like a seasoned predator, survives by exploiting weakness. Its traps are not random. They are calculated maneuvers, crafted to exploit the most predictable flaw in human behavior, the desire for certainty. When a breakout looks obvious, when a move feels undeniable, when the crowd sees a sure thing, that is often the very moment the trap is sprung. Livermore understood this cruel irony better than anyone. He observed that the market often gives the illusion of strength before collapsing, or the illusion of weakness before surging higher. These false moves are not accidents. They are the deliberate tactics of larger players, designed to create liquidity by luring the crowd into the wrong side. False breakouts, the market's bait. A false breakout occurs when a stock or market index moves decisively beyond a well-defined support or resistance level, appearing to confirm a powerful new trend only to reverse abruptly and retreat back into its previous range. To the eager participant, it looks like opportunity. In reality, it is the bait of the trap. The psychology is predictable. Traders, desperate not to miss the move, leap in the moment. Resistance is broken. Their buying adds fuel to the initial surge, but the smart money, the operators who orchestrated the move, are waiting. They sell into that eagerness, reversing the trend and trapping the crowd in sudden losses. The hallmark of a false breakout is the lack of confirmation from volume. A genuine breakout is fueled by broad participation, rising prices carried on a wave of conviction. A false breakout often lacks this. Price pokes above resistance or below support, but volume is weak, hesitant, unconvincing. The tape whispers, beware, failed moves, the market's swift punishment. Closely related is the failed move when a stock appears to begin a powerful trend but quickly collapses in the opposite direction. The failed move is often even more dangerous than the false breakout, because it not only traps traders but forces them to unwind in panic, fueling the very reversal that destroys them. Livermore described these failed moves as some of the most profitable signals in speculation, not for those caught in the trap, but for those who recognize it. Because when a breakout fails, the reversal that follows is often violent, decisive, and sustained. The failed move becomes the true move. The psychology of traps. Why do these traps work so consistently? Because they prey on human nature. The fear of missing out drives people to chase obvious moves. The desire for certainty blinds them to subtle warnings. When the crowd believes the path is clear, they rush forward, and that is precisely when the floor is pulled from beneath them. The market exploits impatience. It knows that most traders cannot wait for confirmation. They act on the first sign, the first twitch, the first headline. But the disciplined speculator, the one who waits for the tape to speak with conviction, avoids the trap and instead profits from the crowd's misfortune. Livermore's first probe. Livermore had a weapon against these traps, the first probe. Rather than committing heavily at the first sign of a move, he would place a small, exploratory trade, a question posed directly to the market. If the market answered favorably, confirming his analysis, he would add to the position. If the market rejected him, he exited quickly with a negligible loss. This tactic served two purposes. It protected capital by minimizing exposure to false moves, and it provided invaluable feedback, because the market itself, not opinions, not predictions, gave the answer. To Livermore, the probe was not a gamble. It was an experiment, a way of letting the market confirm or deny his thesis. The discipline of confirmation. Here lies the essence of survival. Confirmation. The crowd acts on assumption. The professional waits for proof. A true breakout is not only price moving beyond resistance, but price holding that ground, tested and validated by volume. A true trend is not a flicker of movement, but a sustained pattern of higher highs or lower lows, carried by conviction. The disciplined speculator does not rush. He does not chase. He waits until the market itself declares the move genuine. Only then does he commit, with confidence and size. In this patience lies safety. In this patience lies profit. Case study: the head fake. Imagine a stock pressing against resistance. The crowd is watching. The moment it breaks through, buyers flood in. For a moment, it looks like victory, but then, just as quickly, the stock reverses, plunging back below resistance. The breakout was a head fake designed to lure buyers, only to trap them. For those who bought, the reversal is agony. Stops are triggered, positions are liquidated, losses mount. But for the disciplined observer who recognized the lack of volume, who waited for confirmation, this reversal is not a disaster, it is an opportunity. Because failed breakouts often mark the beginning of powerful moves in the opposite direction, turning traps into opportunities. This is the paradox of market traps. What destroys the careless enriches the disciplined. Every false breakout, every failed move, creates fuel for the real trend. The trapped must exit, and their exits power the move that follows. For the tape reader, this is not chaos but order, not deception but revelation. Livermore thrived on these moments. He knew that when the crowd was most certain, danger was greatest, and when the crowd was most trapped, opportunity was richest. The market's cruelty became his advantage. The cost of impatience. Most traders lose not because they cannot read the tape, but because they cannot wait. They demand action. They crave immediacy. They interpret every twitch as a signal, and so they are caught again and again in the market's traps. Their capital bleeds not from one great loss, but from countless small mistakes, each one the cost of impatience. The professional speculator is different. He acts less, but wins more. He does not fear missing out, because he knows the market will always offer another opportunity. He does not chase shadows, because he knows the true move will reveal itself in time. His weapon is patience. His shield is discipline. His edge is confirmation. Lessons of the trap. So let us engrave this lesson deeply. When the move looks too obvious, question it. When the breakout lacks volume, doubt it. When the crowd rushes in, step back. And above all, wait for confirmation. The market will always set traps. That will never change. But you do not have to fall into them. You can instead stand aside, observe, and when the trap is sprung, position yourself to profit from the very reversal that destroys others. This is the discipline that separates the gambler from the speculator. The gambler sees what he wants to see and acts without proof. The speculator waits, listens, and lets the market itself confirm the truth. In that difference lies survival. In that difference lies fortune. In our next lesson, we will confront the most dramatic moments of all, the panics and booms, the extremes of fear and greed when the market shouts its loudest. These are not random storms. They are universal signals of major turning points, and those who can remain calm in the chaos may find their greatest opportunities.